Understanding the ISA is arguably the most critical concept to get your head around as a UK resident. It stands for Individual Savings Account and allows you to earn a tax-free return on your money. There are many different types of ISAs available, specifically 5 for adults and 2 for under 18s, and it's essential to be aware of how they work to take full advantage without falling foul of HMRC's rules. There is an ISA allowance, which is the total amount of money that can be paid into your ISA accounts combined per tax year. That allowance is currently £20,000, but that can change in the future. This means that you can put the 20k in just one of the ISA accounts or split it across a few. However, some of the accounts do have their own lower limits for how much can be put in per year, which will be covered. It is important to note that you can only pay into one of each ISA version per tax year. So, the simplest ISA is the cash ISA. You can only pay in up to £20,000 per year, and all the interest you earn is tax-free. These come in a few different forms, including instant access accounts or a fixed rate account. To be honest, the interest rates given by banks are so low currently that a cash ISA probably isn't the best use of your £20,000 allowance. A better use may be the Stocks and Shares ISA, an investment account used for buying shares and bonds, where all the income and capital gains are completely tax-free. Up to £20,000 can be paid into it each year. In the long term, this ISA can save an incredible amount of money that otherwise would be going to the taxman. However, it is important to highlight the rule that only one of each ISA version can be paid into each tax year. So for example, if you open or pay into a Stocks and Shares ISA held with one broker, such as FREETRADE, then you cannot put any money into another Stocks and Shares ISA held on a different platform, such as Trading 212, until the next tax year. This is important to know as it can be easy to break the rule if you switch brokerages. Another good ISA is the Lifetime ISA, which can be opened by anyone between the ages of 18 and 39. Its purpose is to help people buy their first home, and you can put up to £4,000 into it each tax year, which still comes out of the £20,000 total ISA allowance. The good thing about this ISA is that the government pays a 25% bonus on any money that you put in. For example, if you max out the £4,000, the government will add an extra £1,000 to your account. The catch is that there are only 3 scenarios where you can withdraw the money. Scenario 1 is to buy your first home. It must be on a residential mortgage, though, so not buy to let, and it cannot cost more than £450,000. Scenario 2 is that you are aged 60 or over, and then you can use it as an extra retirement pot. Scenario 3 is if you are unfortunately terminally ill with less than 12 months left to live. You can still make a withdrawal in any other situation, but it will incur a 25% fee. The Lifetime ISA is not a flexible account, but it never would be with the government giving so much free money as part of it. There are 2 different versions: the Lifetime Cash ISA, which just pays interest on your money like a bank savings account does, and a Lifetime Stocks and Shares ISA, where the money that is put into the ISA gets invested into the stock market. This is a good option for people wanting to lock away money for the future to buy a house with. Next is potentially the least known about ISA, the Innovative Finance ISA. This ISA facilitates peer-to-peer lending, so essentially matching up investors with borrowers. This cuts out the bank, which usually acts as the middleman in this process, meaning that you get a much higher return than you would get from depositing your money in the bank. And, of course, the return is tax-free. There is, of course, a significantly increased level of risk in doing this, as if the borrowers default on the loan, then there is no guarantee of getting your money back. You can invest in up to £20,000 of the ISA allowance for this account. Just to help visualise this allowance, let's demonstrate how a hypothetical 30-year-old with £20,000 to invest may allocate their money throughout the tax year. They could put 10k into a Stocks and Shares ISA, 5k into a cash ISA, 2.5k into a Lifetime ISA, and the final 2.5k into an Innovative Finance ISA. Finally, there are 2 junior ISAs, a cash one and a Stocks and Shares one. This is meant for people under the age of 18 and is opened by their parents or legal guardians who manage it. Up to £9,000 can be paid into it each tax year, and this money does not come out of the £20,000 ISA allowance. Once the child turns 18, the junior ISA will convert into the regular adult version, and the child will gain control over it. And those are all the ISAs currently available. Before ending the video, it is worth mentioning that the money held within an ISA is counted as savings and so will affect any entitlement to benefits such as universal credit. If you have less than £6,000 saved up, then there won't be any effect. If you have between 6k and 16k saved, then your universal credit payments may be reduced, And if you have over £16,000 in savings, then you won't be eligible to claim universal credit based on the current rules. Thanks for watching, guys. All likes and comments will be greatly appreciated and responded to. Have a great day.